you explain in a little bit more detail, how is the interest calculated on this loan? People always ask me, well, what is my mortgage payment? And it's like, you don't really have a mortgage payment, right? Because the way that it is it's calculated daily. At the end of the day, it sweeps, right? Calculates interest. And then at the end of the month, it totals up those interest payments and takes that money out the following month, correct?
Yeah. Yeah. The way to think about it is it's a simple interest loan. There is no amortization schedule, no predetermined interest cost. Your payment is never structured to where you have to pay a set amount of principal and interest. In fact, the principal repayment is and the interest payments are separate events. That's really they occur separately from each other, right?
Mhm.
We're so used to sending away a singular monthly payment towards a debt. Again, a mortgage, a student loan, a boat loan, you name it. All loans in the United States are really structured this way. And the all-in-one loan changes that completely because it's a benefit to the consumer if we can separate them. Your deposits that you make into the all-in-one loan checking account, which is where you manage your bills and expenses from, automatically applies your money directly to principal, never interest, never. So this makes it the only truly principal paid first mortgage product in America. I want to repeat that. The all-in-one loan is the only principal paid first mortgage in America that I'm aware of today. Not even a traditional HELOC does that. Right. And then the interest is calculated nightly on the unpaid principal balance. So just to give you a quick example of the math, it's the interest rate times the unpaid principal balance at midnight divided by the number of days in the year. So 365 equals your daily interest cost. Right. And that occurs each night at midnight. Now that daily interest cost isn't charged to the account. It's not charged to the borrower each day. That charge is delayed. So it's just computing it nightly automatically. Right. So once the month ends, each day's interest is just totaled up. Right. So today, maybe my interest expense at midnight was $20.19. Maybe tomorrow after I make a deposit, it recomputes at $15.10, so on and so forth. So it does that each day throughout the month. And then at the end of the month, each day's interest is totaled up and that becomes the interest payment, that total cumulative daily interest. And even then, Danielle, you don't have to lift a finger to even pay for that. The interest payment is drafted automatically from the line of credit, from the all-in-one loan line of credit on the 21st of the following month. And it's not only convenient, but it actually creates a compounded, savings benefit because it's keeping even the money you're going to have to spend on interest in the HELOC for an additional 20 days prior to being drafted, right? So it allows you to continue to snowball the savings and reduce your balance dramatically faster without any, weird effort. You're not having to change your spending or change your lifestyle or make more money. It's doing it for you automatically.